Imagine you run a company. Your stock trades at less than the value of the cash sitting in your bank account. Meaning if someone bought all your shares today, paid off all your debts, and then just walked into your headquarters and opened the vault, they would come out ahead. You are, in financial terms, a piggy bank with a logo.
Now imagine this is true for roughly
That's not a typo. $840 billion parked, not invested, not returned to shareholders, just there. Welcome to the strangest financial story of the century. And in April, Nusan Japan's government decided it had waited long enough.
So what created the world's largest corporate savings account? Why did Japan's companies stockpile cash for 3 decades while the rest of the world was deploying capital? And why is Nisenni the year and not Nisenni-san or Nisenni-su or Nisenni-chu when things are finally starting to move?
To understand that, you have to start where most Japanese corporate stories begin, with the bubble. It is December 1989, the Nikkei Ardmaif Gog, Japan's equivalent of the Dow Jones, closes at San-Maif-Kuhak-was-Twentend. At that precise moment, Japan accounts for roughly 1/3 of global stock market capitalization. One country, 1/3 of all equities on Earth. Tokyo real estate has appreciated to the point where, famously, the land under the Imperial Palace is theoretically worth more than all the real estate in California.
And underpinning all of it is a web of mutual ownership that, in its own quiet way, is one of the most extraordinary financial structures ever built.
It's called the keiretsu. Think of it as a corporate family album, except every member of the family owns a piece of every other member. Manufacturers, Krulos, own their suppliers. Banks, Krulos, own manufacturers. Insurers, Krulos, own everyone. At the peak, Krulos shareholding arrangements accounted for over 2% of the entire Tokyo Stock Exchange's market capitalization, meaning the majority of Japanese public equities were held not by investors trying to earn a return but by partner companies trying to cement a relationship. In practice, this meant management was insulated from accountability in a way that had almost no parallel in the Western world. If your largest shareholders are your suppliers, your bankers, and your long-term trading partners, people who need you to exist far more than they need you to perform, then quarterly earnings pressure is for all practical purposes absent. And if you're not under pressure to return capital, why would you? You hold it.
What happened next is one of the sharpest reversals in the history of modern finance. In the 3 years after December Sengyobei Bashiju, the Nikkei lost more than 6% of its value. It kept falling. By Nisen-sen, the index had bottomed out below wall, a decline of nearly wall. It kept falling. By Nisen-sen, the index had bottomed out below wall, a decline of nearly wall. It kept falling. By Nisen-sen, the index had bottomed out below up-sen against inflated equity collateral. Watch that collateral evaporate. Banks collapsed. The government intervened. The economy entered what economists politely call a prolonged period of low growth, and what everyone else calls the lost decade.
For Japan's corporate managers, the lesson was carved in stone: never be caught without cash. The executives who survived the crash had done so by holding reserves. The ones who hadn't were gone. And in a deflationary environment, which Japan entered and stayed in for most of the next 20 years, holding cash was actually the rational strategy. When prices are falling, cash gains real purchasing power simply by existing. There's nothing irrational about cash hoarding in a deflationary world. It was survivor behavior, and it worked.
So the cash piled up and piled up. According to the Japan Research Institute,
Non-financial listed companies accumulated more than each $1 trillion in cash and deposits, the highest ratio of corporate cash to market capitalization of any major developed economy. The median Japanese company holds roughly 100% of its own market value in cash. The equivalent figure for a large U.S. company is near zero.
By the 2010s, this had become a source of quiet embarrassment. Western investors who looked at Japan's balance sheets saw value traps, companies trading at half their breakup value, run by managers who had no particular interest in changing anything. As T. Rowe Price noted in a Nuth Arsawuv research report, the combined cash and cross-shareholding portfolios of Japanese companies represented an enormous potential return of capital that was simply sitting idle.
Then came Abenomics. In Nokinsei-fam, Prime Minister Shinzo Abe launched a sweeping economic reform program aimed at reviving Japanese growth, and corporate governance was part of the design. The Stewardship Code arrived in Nokinsei-fam, pushing institutional investors to engage more actively with the companies they owned. The Corporate Governance Code followed in Nokinsei-fam, establishing expectations around board independence, transparency, and capital efficiency. These were meaningful steps, but the compliance culture had a familiar Japanese flavor. Companies filed reports, checked boxes, and politely acknowledged the expectations while the cash sat undisturbed.
The breakthrough, if you can call it that, came in March. RR-san, from an unexpected direction. The Tokyo Stock Exchange, Japan's main stock market operator, sent a message to every prime and standard market company, not a request, not a suggestion, a formal directive: take action to implement management that is conscious of cost of capital and stock price. And then, in a move with no real precedent in Japanese financial history, the TSE published a running list, publicly updated, showing which companies were trading below book value, below what's known as price-to-book ratio of 1, meaning the market valued the company at less than the accounting value of its assets.
The list was enormous. Nearly half the prime market qualified. Think about what this actually meant. The Tokyo Stock Exchange, Japan's own institution, not some foreign activist, had essentially stood up in front of the country's most prestigious companies and said, the market thinks you are destroying value, and we are going to tell everyone continuously until you fix it.
In Japan, this is roughly equivalent to a nuclear option. The shame of public acknowledgement carries enormous weight in a business culture that prizes reputation and avoidance of embarrassment. Within months, compliance rates began to move. According to JPX data, by December 2010% of prime market companies had submitted capital efficiency plans. By July 2010, that number had jumped to hatches lick percent. That is a remarkable compliance surge for any country. For Japan, it was extraordinary.
The effects showed up in the data almost immediately. Share buybacks in Japan reached approximately $1 billion in Nissan, a new all-time high, the fourth consecutive record year. In fiscal Nissan, the figure climbed to $100 billion. Mitsubishi Corporation alone announced what was described as the single largest buyback in Japanese corporate history, a program capped at $1 billion, roughly 1 trillion yen. The buyback surge wasn't cosmetic. Combined with improving earnings, it began to move the needle on return on equity, the core metric the TSE had targeted.
But the deeper transformation was happening in a corner of the market that most people outside Japan don't track closely: the insurance sector.
Japan's three largest non-life insurance groups, Tokyo Marine, MS&AD, and Sompo, had, for decades, held enormous portfolios of cross-shareholdings. These weren't investments in any conventional sense. They were keiretsu relationships institutionalized in stock form. In Nisen Arsrov, all three groups announced they would liquidate their entire cross-shareholding portfolios, the combined value approximately $1 billion, 9 trillion yen. When the insurers announced this, the signal was unmistakable. If the patient holders of keiretsu relationships were exiting, the architecture of post-war Japanese corporate finance was being dismantled from the inside.
Cross-shareholdings have already dropped from over 60% of TSE market cap in 1990 to roughly 40% today, according to research from Nomura, and the pace is accelerating. But the mechanism creates its own complication, one worth understanding. When a major insurer sells its cross-holdings, someone has to buy them. Mostly that someone is the companies themselves conducting buybacks to absorb the supply. This is actually healthy in the long run. It reduces the share count, boosts earnings per share, and forces companies to think like owners.
But in the short term, it can create selling pressure that pushes prices lower, which is why the TAC has been careful not to set a deadline that forces a fire sale.
Now add a third force that would have been unthinkable 10 years ago. Activist investors are winning in Japan. For most of Japan's post-war history, foreign activist funds were treated with something between polite skepticism and open hostility. Elliott Management, the New York-based hedge fund known for aggressive campaigns against corporate complacency, spent years trying to make inroads in Japan with limited success. As recently as Nisen, the prevailing wisdom was that Japan's corporate culture was simply impenetrable to Western-style activism.
Then the TSE changed the rules, with management suddenly obligated to explain capital efficiency decisions to a public audience. Activists found they had an argument that worked. You're destroying value, your own regulator agrees with us, and here's the number. In a Reuters analysis published in April, Thassen Look under the headline "Once Shunned, Activist Investors Dig In to Win in Japan," the reversal was documented in striking detail. Known local hedge funds now account for 60% of activist activity in Japan, according to Jefferies.
Elliott won a notable engagement with Toyota in early TOS-RE, securing commitments on capital allocation from the company that is arguably the most powerful symbol of post-war Japanese industrial capitalism. Elliott has since disclosed new positions in Daikin, the air conditioner manufacturer, and Mitsui O-Sky Lines. Seth Fisher of Oasis Management, another prominent activist fund, is running campaigns against Kao Corporation, Japan's equivalent of a Unilever or P&G, and has engaged Calbee, Japan's largest potato chip maker, on shareholder returns.
Fisher told investors in Dusen Ersawu, "There remains an enormous amount of momentum, and we're coming to an inflection point where the upside is even bigger."
Which brings us to April. Lusen Arshaluten. On April 3rd, an expert panel convened by Japan's Financial Services Agency approved a draft revision of the Corporate Governance Code, the first rewrite in 5 years. The draft was published for public consultation on April 10th. The final version is expected in summer. Lusen 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 Lusen.
This revision matters not because it introduces entirely new principles. Japan has had governance codes since Nisen Vul, but because of a specific and significant shift in language. Previous versions focused on disclosure. Companies were expected to explain what they were doing with their capital. The Nisen Luck draft moves toward verification. Companies will be expected to demonstrate that they are actually deploying capital effectively. There is a difference between telling a regulator we have a plan and showing them that the plan is working. Japan is crossing that line.
Simultaneously, amendments to the Financial Instruments and Exchange Act take effect in May, Nisen Arseluk, adding further regulatory teeth to the FSA's toolkit, and Prime Minister Sanai Takaichi, who replaced Kishida in late Nisen Arseth, has made explicit her position that idle corporate cash should flow into wages, capital investment, and economic growth. This gives the reform political durability beyond any single regulator or market cycle.
The response from global investors has been immediate. According to IFA magazine, Japan entered a new phase in Nisen Niduluk as net foreign flows surge. Since mid-to-Arstervor approximately $2 billion 2 trillion yen in net foreign institutional investment has moved into Japanese equities. The Nikkei crossed Guoman yen for the first time in history. Goldman Sachs Asset Management, Janus Henderson, Invesco and Man Group have all published analyses in Nisen Niduluk pointing to governance reform as the primary structural driver of Japan's investment case.
Morgan Stanley has forecast that Japanese corporate Arlo could reach % by Nisen Sanjus, up from Q% today, and from below % just a few years ago.
The 5x billion question is, why is this happening now? Why Nineal Luke and not Nineal Luke and not Nineal Luke and not 4? The answer is 5 converging forces arriving at the same time.
The first is inflation. For 20 years, holding cash in Japan was rational because prices were falling and cash gained purchasing power by doing nothing. That logic evaporated when Japan's inflation rate rose above 2% and stayed there. In an inflationary environment, idle cash erodes. The incentive structure has genuinely reversed.
The second is the TSE's Arsene intervention. The public naming and shaming of capital destroyers removed the fig leaf. Companies can no longer quietly ignore the problem when the stock exchange itself is publishing your underperformance on its website.
The third is the insurer unwind. When Tokyo Marine, MS&AD and Sompo announced they were liquidating $1 billion in cross-shareholdings, it triggered a cascade. Partners who had relied on those insurers as stable, friendly shareholders are now facing open market dynamics for the first time. The keiretsu is not dead, but it is visibly contracting.
The fourth is the activist breakthrough. Elliott winning at Toyota, the most symbolically significant company in Japan, sent a message to boardrooms across the country: the old rules no longer apply.
And the fifth is the RCR code revision. Every previous reform gave companies room to move slowly. Disclosure requirements allowed box ticking. The verification shift in the RCR draft closes that exit. By the time the final code drops this summer, the legal and regulatory architecture will have shifted from explain yourself to show your work.
It's worth stepping back to ask why Japan's companies never did this on their own. Why did it require this degree of external pressure to unlock capital that any finance textbook would say should have been deployed decades ago?
The answer sits in something deeper than regulation. Japanese corporate culture has historically valued continuity over maximization. The CEO who builds up cash reserves and weathers a decade of low growth is praised as a prudent steward. The CEO who deploys capital aggressively, earns high returns for a few years, and then gets caught in a downturn is seen as having gambled with the institution. In a country where the institutional memory of the Shin-Kyu-Hashju crash is still alive in many boardrooms, where some current executives were mid-career when the Nikkei lost %, that caution wasn't irrational.
It was a reasonable response to a genuine civilizational shock. What's changing is not Japan's values, it's the environment in which those values operate. When deflation ends and inflation begins, holding cash becomes expensive. When a stock exchange publicly lists you as a capital destroyer, silence becomes costly. When an activist fund wins at Toyota, the calculus shifts for every company watching. The culture hasn't changed, the pressure on the culture has.
And that's the Japan factor here. Japan's governance revolution isn't a conversion to Western shareholder capitalism. It's not companies suddenly deciding that quarterly earnings are what matter. It's something subtler and arguably more durable, a structural incentive shift that makes the old behavior expensive in ways it wasn't before. The same management culture that once hoarded cash as a survival strategy is now slowly being pushed to recognize that hoarding has become the risk, not the protection against it.
The real question now is whether the reform achieves depth or merely breadth. Japan is exceptionally good at coordinated surface-level compliance. The Hachislick % plan submission rate in 7 months is evidence of that. What's harder to measure is whether the plans represent genuine strategic change or sophisticated box ticking. As one foreign institutional investor put it to Reuters this year, the risk isn't that Japanese companies will resist reform, it's that they will perform reform, submitting plans, conducting buybacks, checking boxes, without the underlying shift in how management thinks about capital.
The FSA's Nichen Nishilu verification requirement is an attempt to close that gap. Whether it succeeds will determine whether Japan's $6 billion problem becomes Japan's $6 billion opportunity, or just another disclosure document filed, acknowledged, and set aside.
For the first time in 30 years, the evidence suggests the gap is actually closing. The cash is beginning to move. The cross-shareholdings are unwinding. The activists are winning. The regulators have sharpened their tools.
The piggy bank is finally being opened. What happens to the money inside will be one of the defining stories of the next decade of global finance.